Thank you. Oops, got it. Hello, everybody. I'm Bonnie Halper, and I write the weekly Startup One Stop newsletter. And for the last 9 years now, yes, it's been 9 years, we've been hosting these breakfasts now virtually every 2 weeks, Thursday morning, 9:30 to 11. And we thank Kettle Space for hosting us. And Brenda, tell us about Kettle Space and what's new. Kettle and what's new with Kettle.
Thank you, Bonnie. My name is Brenda. I'm the marketing assistant for Kettle. Kettle is based in New York City. We partner with organizations to help them return to the office with our hybrid work application. Thank you, everyone, for joining. I don't know who wants to start introducing themselves. Anyone wants to go?
Oh, let's go through the room. Oh, our guest investor this week is Josh Futterman of Papa Bear Ventures, but we're going to have everybody, all the attendees, introduce themselves. Trip. Oh, Craig Bromberg. Oh my God, we haven't seen Craig in a long time. Craig, introduce yourself and tell us what's new with you.
Hi, Bonnie. How are you? It's been a while. Yep, nice to see you. So my glasses, I can't see anything. Since I've last been here for the last 15 months, I and my co-founders Brad Reisner and Serena Chu have started a company called Homesy, and Homesy is the first social real estate app. It's really an app for consumers to discover a different way of thinking about real estate in community. It's a collaborative platform. We've raised under 100K, but over that time we've done built wireframes. We now have a full MVP. We worked with a company in Israel to do our UX and UI, and we're doing MOUs with brokers and design, not just individual brokers, but broker teams and business of home, a couple of home design people to create supply side capability as we enter the network. We're about to put the product into the market in about 60 days. And we think that that's the entree to doing a pre-seed and then a 3-city test for 3 regional DMAs, probably Nashville, Pittsburgh, maybe Austin. We keep going around the 3rd city. But we have pretty much, we're really on the launch pad and moving forward really quickly. And it's a great group of people. We just hired somebody to really run marketing for us as we go forward. Really cool. So
thank you. We do try to keep.
Sorry.
I said we do try to keep introductions short so we can go through the room and hear from Josh. And thank you, Craig. So Sam, tell us what's new with Axle.
Well, we just completed our first $1 million revenue year, which is very good. Kind of psyched about that. And we're in the middle of our seed round raise. So looking to raise 1.5 million, and it looks like we have it pretty fully committed at this point, which is good news. I'll believe it when everything is signed and the funds are wired, but it does look good. Working on some really cool product rollouts for the spring, basically new capabilities. For those that don't know, we do video, collaborative video software, essentially, that lets teams work remotely with professional video content. And anyway, Happy New Year.
Oh, thank you. You too. So Adrian Stern, welcome back. And
yes, hi, Bonnie. Good to be with you all. Josh, nice to meet you. I'm the CEO and co-founder of Reveal. We're building a royalty management platform for Web3 creators. Had a beta going since August with 1,000 creators on it. We're raising a pre-seed round of 1 million now, and eager to look, hear a bit about how you think about the Web3 space, Josh.
I know you must be focused there, considering what you all do. So, Ian.
Okay, well, hello everybody. So I'm in Toronto, where I am working on the Canadian launch of the Virtual Film School, which is based in Hollywood and London. And we are also doing a seed raise right now, looking for about $1 million. And that's me.
Oh, thank you. Helene.
Hi, everyone. Happy to meet everyone. I'm currently in Portugal, Lisbon. I was in New York before, and I'm currently looking to go back to New York. I'm working on a project that's a SaaS platform for automation of client feedback. Starting to work on the MVP and yeah, starting to look for raising, and here I am.
Oh, welcome.
Thanks.
Mahmoud, welcome.
Hi, Mom. How are you? So yes, I'm the founder of Diamond Hedge. It's the first augmented reality diamond price comparison company where you can try on different diamond rings from anywhere in the world. We have around $5 billion worth of diamonds on our platform and been growing around 150% year over year for the last 3 years. So, yeah.
Thank you. So Tommy Jenkins.
Hey, Bonnie. Notice I have Bizu for all of you.
I was going to
As
say, I want
requested.
Bizu to introduce himself.
Bizu needs no introduction.
So Bisu's shown up at the breakfast before.
Yeah, so thanks, Bonnie, for having me and Kettle Space. Thanks, Josh. I am Tommy Jenkins. I've had a number of different roles in tech and startup. Right now I'm working on natural language processing and sort of its applications to conversational intelligence, and I'm working on a dating app. So that's me.
Thank you. Trip, always good to see you. Were you able to introduce yourself? Oh,
I think we may have lost him.
oh, he'll be back. I know that he sometimes has technical difficulties where he is. David.
Hello, I'm David Feltzat, currently in the Maryland area. I've been working on a digital health startup for a little bit now. We're actually entering private beta next week, which we're happy about. We're essentially trying to be the supplemental care platform for families, essentially maintaining health in between doctor visits. We're kind of starting with the maternal and child health space. So we've actually built a kind of on-demand marketplace and telehealth platform for maternal and child healthcare, connecting families with different type of people like lactation consultants, sleep consultants, doulas, and 20 plus other kind of expert types eventually. So we're actually going to be launching pretty soon and probably raising a pre-seed round to kind of get that off the ground. But we're excited for the new year and to get running.
Oh, thank you. Dan Sola, you're muted, but please do introduce yourself.
Muted and invisible. Dan, I'm in Oxford in the UK, so just tried to stop the sun streaming in, giving me too much of a halo. I'm working in the robotics and AI space. The company's called Archangel Imaging. We deploy smart machines alongside people for some really stubbornly persistent problems that happen right at the edge of the network. The example everyone loves to talk about is anti-poaching. So a lot of our deployed AI stuff has gone out to East Africa to help in anti-poaching. It's also deployed on the UK rail network for metal theft and suicide prevention. But about 2/3 of our income is defense. And we have bootstrapped to date. And we're at the point in time where we need to accelerate and sweat the assets with it, basically.
Oh, thank you. Oh, I know we had some. Oh, Matthew.
Hello.
Also, introduce yourself and tell us what you're working on.
Yeah, absolutely. So my name is Matt Yuan. I run a company called Countin. We're an online, we call it so AI-based online booking agent for hospitality live music. We actually been working on this for a little bit longer, probably than most companies at our stage. But we've been in this business for 3 years. Had a great success when we first launched our first product in 2019. COVID came around in 2020, shut down our industry. Come 2021, we went from survival to reopening to rapid growth. Currently raising a 1.5 round seed round to get us out of this stage. And we got, I think, just something that's positive is we got a commitment from the founder of Jiffy Lube yesterday. So yeah, so that's a little bit about myself and hoping to solve this great problem that'll help musicians and small businesses.
Oh, good for you. You and Adrian should talk. He's also in a cousin space.
Absolutely.
So Josh, yes, you two should talk. Josh, The floor is yours.
Okay,
Tell us
nice.
about you and your background as both a founder and an investor.
Absolutely. So I will take you back to the early days. So I grew up in a very entrepreneurial family here in Manhattan. And so it very much was in my blood. And I founded my first company when I was in college at Cornell. It was one of the early mail order and phone order software and hardware companies. And we were focused pretty much exclusively on colleges and universities in the Northeast United States and found that I really had a passion for it. I ran it for about a year and a half before I sold it to one of my fellow students, moved on to something else. And ever since then, I've been a serial entrepreneur in a variety of spaces, including when I got out of college, I ended up becoming a record producer, artist manager, music attorney for about 14 years. I had grown up around that world as well. Somebody is unmuted.
Yes.
And at the tag end of that, back in the late 1990s, during Internet 1.0, I launched one of the early internet music companies. We were the first company, because of my background, to have the trust of the major labels and the big publishers, the big indies, and ran that company for a couple of years. It was free, everybody having broad bandwidth. So if you remember, it took like 12 minutes to download a 3-minute MP3 song. But we got a lot of wonderful press. We had about 50,000 users despite that. And I ended up selling that company to one of my early investors, not for a fortune, but for enough to give me about 3 or 4 years to figure out what I wanted to do next. But I was truly bitten by the bug at that point and went on to found 4 other tech and tech-enabled services companies over the last 22 years in a variety of different areas. The most recent of which, ParkU, I put on hiatus at the beginning of the pandemic. We had solved the parking problem, the street parking problem in New York City, but we did most of our member recruitment with brand ambassadors on the streets, knocking right on people's windows during alternate side parking and getting them to sign up right then. And I expect that I will, through Papa Bear, end up studioing that project in another 1.5 or 2 years, because it hasn't gotten better, it's only gotten worse. And we found the solution and just need some money behind it. Anyway, so that brings me up closer to the present. So while I was launching all of these companies about 11 years ago, I moved to Singapore for 3 years. And prior to that, I had sporadically been mentoring and advising other founders, starting in the mid-90s with some friends of mine who had started the original 24/7 Media. Some of you may remember that was one of the early advertising networks, internet advertising networks. And I always enjoyed it. And I would go and I would do guest lecturing at classes and things like that. But it was very sporadic. When I moved to Singapore, some friends of mine were starting the first serious accelerator in Southeast Asia called JFDI. And they asked me if I would get involved and be the principal mentor for their first cohort of the program. So I dived in and I helped them run some startup weekends around the region, and then became the principal mentor for that cohort. And it was like I had found my people. I absolutely loved it. And ever since then, I've now mentored over 200 other founders, many of them, probably 30 of them, for periods of 6 months or more, and many of them just once or twice. I love doing that. I found I enjoy it at least as much as I do starting my own companies. And so just before the pandemic hit and I had put ParkU on hiatus, I started to think very seriously about starting my own venture fund. And there were some reasons for this that were pretty New York specific. One was that there are basically no people running funds in New York that have significant founder backgrounds. Quite common in the Bay Area and in a few other places, but not here in the city. And I thought that that was a big problem for innovation in New York, and one of the reasons that we weren't catching up faster. Also, one of the reasons that we have very few investors that are investing at the stage that I would call late pre-seed and early seed. What used to be seed, right? What used to be seed. Right now, most of the seed funds are really what used to be Series A. So if you don't have $1 million in AUM or 80 to 100,000 in MRR, it's hard to get them to take a look at you. And I wanted to do something that was somewhat earlier than that. where there was the possibility that a real business was getting built. But I could bring in all of the experience, mentoring capability, ability to introduce people to other investors, to potential clients, and most importantly, to be able to hold founders' hands while they're going through what I consider to be the most difficult part of the founder journey, right? So that was really what got me into doing this. I was going to start a traditional fund. I was going to raise $40 million to do it, with investments averaging about $500,000. And then I started the raise about 2 weeks before the pandemic hit. So those of you who are founders here who've tried to raise before, you know how difficult that is. It's even harder to raise for a fund. So when the pandemic hit, of course, I had to put it on hiatus as well. And I stepped back and I said, well, you know, what do I want to do while this pandemic is going strong and you know, people are suffering? And I decided I want to take some time to step back, help my friends and my mentees get through the toughest parts of the pandemic, and then also sort of look at what I really wanted to do going forward, where I wanted to have the most impact. I've never been a heavily money-driven person. I've always been a person who's been interested in making the biggest difference for others that I possibly can make. So that had a big influence on what I did during the pandemic and where I am now. So getting through the pandemic, I helped a couple of my mentees who I was working really closely with, who were founders of companies that were making some nice progress, survive it. And one of them was a company called Revelio Labs that had gone through the NYU 300K challenge. I had been mentoring that founder for about 2 years when the pandemic hit at that point. And I had helped them get into the Barclays Accelerator, helped them figure out what their strategy was going to be in their initial business development. And they had managed, coming out of the accelerator without taking additional money, to get their to get the company up to 135,000 in MRR. And it was all inbound at that point. And so we went out to start raising their true seed round, and they managed to raise $4 million on a $29 million valuation here in New York, which is pretty unheard of for that valuation. Even in the Bay Area, for a first-time founder, that's a lot. The founder was originally going to only raise $2 million. And I said, you're nuts if you're taking money at that valuation at this stage. You're going to have to build up your business development and sales team really quickly. And I recommended he raise $5 million. We settled on $4. So he did that. So that was a nice win. The second thing that happened was another founder I've been working with for about 5 months before the pandemic hit. He had come out of the sports marketing business. He had worked for the Brooklyn Nets. He's actually a young Australian guy. And he had created a platform to enable non-gamblers to participate in predictive gaming. And so how did this work? You didn't have to put any money in. It was all funded by sponsorships and by advertising. And you could actually win money and prizes, things like that. He had a $1 million contract with Comcast to pilot it in 1,000 bars and on 10,000 Comcast customers' phones. When the pandemic hit and all the sports shut down, of course, that had to be put on hiatus as well. He was freaking out. What am I going to do? I've got 150 grand left. I got my team. How am I going to survive through this? So I spent about 2 weeks with him, really sort of working on where he could cut back and really give himself as much runway with that little bit of money as possible, and got him to walk back from the ledge. And then we started brainstorming where else he could go with this. And about 15 minutes into the brainstorming session, like a light bulb went off in my head. And I said, have you ever thought about trying to do this for reality television? And he said, no, I've never thought about that. It's really interesting. 3 months later, being the business development maven that he was, he had a pilot deal for the Real Housewives. And he leveraged that deal into transforming the company from more consumer facing to white label, was able to build it up over a period of about 8 or 9 months, and then do a reverse merger with a Canadian holding company and go public on the Canadian and Frankfurt stock exchanges and over the counter. So he went from almost losing the company to raising $10 million at a lower valuation than he would, a higher valuation than he would have had he raised from VCs at that point. So that was really exciting for me with it. And at the same time, another company, the company I'd worked most closely with during that accelerator in Southeast Asia, they ended up selling for about $200 million to Intuit. And I had been responsible for helping them turn what was just a set of individual concepts and ideas into a real business, and also encouraging them, much to the consternation of the founders of the accelerator, who wanted everybody to focus on Southeast Asia, to focus on the North American market. But it was what was appropriate for them, and that worked. So all three of those things happened at the same time. I was also helping my friends get through this. And I figured, okay, well, given that and the successes my other mentees have had, maybe I do have the ability to pick them and help. Now, this is April of last year. Do I want to launch a traditional fund like I was going to before and chase LP money for 18 to 24 months? Or do I want to do something different that has the potential to really not just be successful for me and my investors and my portfolio companies, but also change the face of venture? And I'm somebody who always plays really big. I've been active in democratic politics since I was 9 years old. I, as a founder, try and bite off and deal with really big problems in various areas. And all of the things that I've done have been designed to make a difference, a meaningful difference in the lives of the people who end up using them. And so that's what I really wanted to do with this. So I came up with a completely new structure for a venture fund. And I had three goals with this structure. I leveraged, I have an MBA in marketing and finance from Stern. I have not one, but 2 law degrees, even though I'm not a practicing attorney and haven't been for a long time. With that, and then of course I have all of this experience as a founder and mentor. I wanted to pull all of those things together and accomplish 3 things. So the first thing that I wanted to do for me was I wanted to get my fund off the ground as quickly as possible and start making investments. So I didn't want to have to chase LPs for 18 to 24 months, even though I had the capability to do it. So that was the first thing. Second thing that I wanted to do was I wanted to make high-end early stage venture accessible to any accredited investor. So we're not talking about crowdfunding, things like that, which is really just you're throwing your money at things. So it's real venture with great deal flow, where I do all of the vetting, I do all of the diligence on it. But I wanted to make it accessible at a low entry point with less downside risk, to get a lot more people who were even moderately successful professionals participating in this market, because I felt it would really make a big difference on the kinds of investments that could get made in the future and how people viewed venture. So that was the second thing that I wanted to do. The third thing that I wanted to do was I wanted to create this as a template so that in a year or 2, I could start sharing it with other people who wanted to start their own funds, who have the chops and a decent professional network, even if they don't have LP relationships, or like me, don't want to chase LPs for 18 to 24 months, to get their funds off the ground quickly and easily, especially underserved minority and women GPs. And this is very important to me because I feel that venture in a lot of ways is broken at this point, and that would improve things tremendously. And it's not just a hype thing for me. I actually am based in Harlem, and my family is a mixed family. I grew up here in Manhattan, in the most integrated city in the world. So, it's both a fairness thing and I think good business going forward. And my goal with it down the road, beyond really building PapaVer Ventures into a monumental success, is to also build this whole satellite network of these great new first-time venture funds where we're all able to support each other with deal flow and other things, and really be able to make a dent in the transformation that I'm talking about. So that brings us to the present. So how does my fund work? How does it differ from a traditional fund? First and foremost, we don't have a pool of money, right? So it's not an angel group, it's not an investment club, it's not a bunch of people sort of sitting around while the supplicants come and pitch to them, and they make 3 or 4 investments a year, if that. It is, like I said, a real venture fund, but with some optionality for the LPs, and with this lower entry point and less downside risk. So I have what I call member LPs, and I have 2 levels of member LPs. at the lower level, which is for people who are successful professionals who want to dip their toe in the water, learn about venture, really participate. It's $1,500 a year, a membership fee. And at the higher level, which is more for more traditional types of LPs, high net worth individuals, people who've been doing angel investing over the years, family offices, funds of funds, so on and so forth, that's $5,000 a year for them to come in. I do not charge a management fee. So it's only the membership fees, and this makes it significantly less expensive over the same investment time horizon for member LPs to come in. So for the lower level folks, it ends up being about 40% of the cost of a traditional fund, and they couldn't get into one anyway, because generally you got to write at least $100,000 check if it's any kind of meaningful fund. And then for the higher folks, it's about 70% of what they would normally pay in management fees, and it can drop down. No matter what level you come in, though, you have to commit to investing in the first deal after you join, and at least 50% or a minimum of 6 deals in each year. And I will generally present 12 deals a year, but you can come in on all of them if you choose to, or as many as you want. But there's a guarantee there. So in that way, it's very similar to an actual venture fund, but with that little bit of optionality. So what does that mean for you as founders? It means right now, when I've got about 17 member LPs, we're doing $50,000 to $100,000 checks. When hopefully at the end of the second quarter of this year, I get up to my max, which is going to be somewhere between 150 and 200, member LPs will be cutting checks of $250,000 to $500,000. I only invest in the very narrow band of what I call late pre-seed to early seed. So what does that mean? It means you got to have a solid team in place already. You got to have a first version of your product that's beyond just an MVP that you've thrown out there. It doesn't have to have everything, but it has to work pretty well. You've got to be at least in paid pilots generally, or if you're B2C as opposed to B2B. And by the way, about 80% of the investments we'll make will be in the B2B space, about 20% B2C and B2B2C. I'm agnostic as long as it's software or software driven. There can even be a hardware component as long as there's some kind of consistent revenue coming through related to that hardware. And I can tell you about some of the deals that I'm looking at right now that are similar to that, as well as the software deals when you ask questions. What else can I tell you right off the bat? Generally won't invest in deal sizes bigger than about 2 million. So sort of our sweet spot is the $1 million to $2 million range. And I don't invest in valuations above 10 million post generally, because that's the highest number for me to get the kind of consistent returns that I need to get for my LPs. And also I feel that that's a pretty fair number. Right now, there's a ton of money chasing deals, and the valuations are being driven through the roof because of that. And they really don't make a lot of sense on either side. And I think that when you're a large venture fund and you've got hundreds of millions of dollars under management, you got to deploy that capital. You're going to chase what's out there. When you are not doing things that way, I think you're going to end up in significantly better deals. And I think it makes for a much more of a partner relationship with the companies in the fund when the valuation is fair to both sides. So that's the way that I look at it. What else can I tell you off the bat? Another thing that I do. So for my lower level folks, they put through the fund, and we do each deal as an SPV to comply with SEC requirements. They put $3,000 into each deal. The higher level folks have a minimum of $5,000 that they have to put in. But if they put 10,000 or more in through Papa Bear, and they really like a particular company that we're investing in, and they want to write a much bigger check directly into the company, I will then make the introduction to that company and give my imprimatur. The other thing that we do that's really unique is I take a regular 20% carry. And if you don't know what a carry is, you can ask me during the question session, but it's the commission on any exits that you get as a VC. And so I take 2% out of my carry in any given year when we'll have an exit, I take 2% of the exit revenue that would go to the investors, and I put that into a reserve fund for the given year. And if any company we invest in goes out of business within 3 years of us making that investment, I make my investors whole up to the amount that they invested in that company out of the reserve fund. So what does that do? It makes investing in early stage venture much more like a real estate investment. Your downside risk is lessened substantially, and your upside risk is much greater, right? So, it tends to make people a lot more enthusiastic when they know that the likelihood of losing all their money is minimal going forward with that. So it's really beneficial to companies as well to be able to do this. And as far as I know, I mean, every response that I get from investors and LPs and other people who know this world, nobody else has done this yet. So it's exciting, and I expect that that will be something that gets picked up by a lot of people in the future. So why don't I leave it at that and open, because I've given you a lot of information, and open the floor up to all of you to ask any questions that you have.
Oh, before we do that, I know that we had 2 latecomers, Bradford and Carolyn, and please feel free to introduce yourselves and tell us briefly what you're doing. Carolyn?
Yep. Hi, I'm Carolyn Sloan, and I founded Teach Me TV, which is an ed tech children's media space company. And what I mean by that is we produce everything from interactive activities for kids that schools can use and parents can use online to close the learning gap that everyone has experienced in the last 2 years with their younger children, ages 5 to 11. And we also produce interactive television, meaning that it's not passive experience for kids, that they actually interact with the video on the screen. And we started, we actually formed in 2019, but didn't really get started until 2020. And we've been doing okay since. So we're just starting some pilots in schools now. We have about 3 New York City schools, a mix of independent and charter schools. And then we're planning to enter the consumer market sort of through the back end, through teachers recommending us to parents.
Oh, thank you. And Bradford. Oh, where is he? Oh, you're muted if you want to introduce yourself. Here's your chance. I guess not. So questions.
He may have logged in and then ran to get some coffee.
Oh, okay. So questions.
Who's gonna hit me first?
I guess I could go first. So, Josh, I wanted to ask, since I used to live in Singapore as well, wanted to ask you how you feel about the startup scene in Singapore compared to New York, and which one you think, which one you like better.
I would say the startup scene when I was there from 2011 to 14 was nascent. The government had been trying to push it, but Matthew, as you probably know, from a cultural standpoint, it's really difficult because the parents wanted their young people to go into safe jobs, right? And that's an endemic sort of approach throughout Asia. It took a while for the things that the private sector that was mostly being driven by expats was doing in the startup space, and the government sort of figuring things out how they wanted to promote things to begin to get over that. And so, when I was there, like I said, the startup scene was driven almost exclusively by expats. Or people who were Singaporean who had been overseas and come back, and that was the mix at JFDI, the accelerator that I was with, that really sort of jump started the startup scene. I haven't been back since 2016 at this point, but I keep in touch. I've got several hundred connections still over there, and I keep in touch with them. And the startup scene has really taken off. Obviously, you've got Grab and some other unicorns that were actually started in Singapore by locals over the last 7-8 years, and those have really begun to make a big difference over there. The startup scene in New York is still much, much bigger. Just a bigger place with more money. And also, I think Singapore is still somewhat limited because while it is, I would call it the most westernized place in Asia, it still only gets a limited percentage of people coming from other places, right? And generating that kind of level of enthusiasm, whereas New York is probably the preeminent global city. And we get so many people coming here from other places to do things. You know, even now people are started choosing New York over the Bay Area at this point. Even with the pandemic, I know a lot of people moved here and said, hey, look, we know what's going on all the time. So, you know, if I was going to do a startup, I would choose New York over Singapore, especially if I want to focus on the United States or globally. But Singapore is a great place to live. I loved it over there, and there's a lot of opportunities. And one of the things about Singapore that you don't have, not just in New York, but any place in the States, is you do have all of this government support for the startup scene. So if you were over there on a long-term visa, you can tap into that. There's money, there's tax credits, there's all sorts of things that you can't find here. Israel does some similar stuff as well. So, you know, if you're looking at Asia, I would say right now, Singapore may very well be the best place in Asia to be developing a startup, especially if you're going to start in that region. You know, that's your focus with your customers. And I would put Singapore definitely in the top 8 or 10 places in the world now to launch a startup.
Yeah, my friends who have got founder friends who have gone back and moved back have said that there's a lot of money around from government and Southeast Asian wealthy families, but not enough founders to actually go and do something. So,
yeah.
Thank you.
Who's next?
And founders, if you're looking for...
I'll happily hop in here.
Oh, go ahead.
Josh, I wanted to touch on your past. Yes, it's me. I'll turn on the video for a second, but I'm going to the gym, so I don't want to impose that on you guys. Yeah, I wanted to touch on your experience in the music industry, because that's where I come from. I spent 10 years as a touring musician, but managing the record label. I founded as well, and you know, looking at sort of Web3 and blockchain and the potential for artists to just collect a bigger share of royalties and collect them so much faster. I'm curious to what is your, you know, sort of perspective on the Web3 space.
I'll just jump right in. I'm not a fan of crypto. Not a fan of crypto. I think most of what's going on is, I won't necessarily say a con, but there's a lot of delusion right now. I do believe that blockchain has a role to play going forward. And I think there will be some companies that come out that really take advantage of it. But right now, it has a lot of problems, including a huge amount of energy use and other ways of doing a lot of these things that are actually quicker and easier to do that give similar kinds of protection. I am interested in game-related and utility NFTs. And I actually attended NFT NYC, a bunch of the events, and I'm a member of Upstream. By the way, if you aren't on Upstream yet, you should definitely join. I'm sure Bonnie knows Upstream, right? With that, and it's got some great communities on there, including one of the best NFT communities in the country, if you're interested in that. You know, this has been the dream for artists for decades. You know, how do we manage to claw back most of the money, especially from our recordings that we're making? But the music business has changed tremendously from when I was in it. And I don't see a day when anybody other than the most well-known artists in the world can make a ton of money off their recordings anymore. I just think it's too difficult. I think that the world has changed. The way that people, and young people especially, consume music is very different at this point. So the route that it's taken with, you know, artists being able to go out, get on the road, make money, live touring, obviously when we don't have a pandemic going on, merchandise, licensing, I think for a long time into the future that's going to be the way that artists really have to make most of their money, unless they're extremely well known going forward. And I don't see, you know, I look at blockchain is sort of a tool, and Web 3.0, you know, is this adaptation that a lot of people in the crypto community are looking at, sort of very similar to the way people were looking at the internet at the very beginning. We're going to be able to do this and democratize everything. And my feeling is that human beings just, they don't tend to go in that direction. And then beyond that, using it right now is extraordinarily difficult. I mean, for me, I'm a tech expert, and I still haven't bought NFTs because of two things. One, I find they tend to be overpriced by the time that you jump into them. And two, you got to jump through hoops to make the purchase. And there are people out there that are trying to make these things somewhat easier, but it is going very, very slowly. It's going very slowly. So that's you know, that's my feeling about it.
Yeah, no, and I totally hear that. I mean, the user experience in the crypto space is still, you know, has a lot of progress to make. And I think that is normal. It's still fairly nascent. It's, you know, it's not unsimilar to the beginning of the internet, where you had to wait 3 minutes for your modem to connect, you know. But I guess what I find interesting is the fact that there is an opportunity to bring scarcity back to some of the assets, right? Which has been totally lost in the streaming era. Which is bringing value back to the art, to the music at least. And so I think there's potential there in you know, sort of changing the perception of what music is worth, and through ownership of fans. So anyways, thanks for sharing your thoughts on that.
Sure, absolutely. No, and I hear what you're saying with that. And you know, when it comes to NFTs, I mean, I think if you own something that you actually have rights in and can make money off of it, then there's potential value in that. And you see that with certain NFTs, and you see that with some of the pay to earn games. But I haven't seen it in most other areas yet. And for example, the you know, the sort of standard art NFTs, 99.9% of the artists who are putting stuff up online are actually losing money at this point. So, you know, if you can overcome that in some manner, and actually make it so that it's something that's truly scarce instead of just a bunch of people saying it's scarce, then I agree, there's some value in that. But
right.
It's still far from proven to me that is really doable at this point. And right now also, you know, it's still, despite the fact that it's all over the press, it's still very niche. It's still very, very small percentage. And the only way that this becomes truly successful and not a Ponzi scheme is if you get average people out there buying into it. And I'm not sure that that's possible before things go poof. So we'll see over, I'd say, the next 24 to 36 months what happens with it.
Yeah, thanks for sharing that.
Who's next?
I'll be next. Hey, Josh.
Craig, I'm familiar. I think you and I may have met at some events before.
I think it's totally possible, and I think also you're a Stern graduate. I'm a Stern graduate. I mean, so could be that, because a lot of backstory. So, you know, one thing I really appreciate, you know, Ed Zimmerman is my lawyer, and you know, we talk a lot about, and we actually changed our name from Homegoer to Homesy after we found out, for example, that homegoing has a very specific connotation in the African American community, which is that after the bereavement, it's like Shiva for Black people, which is basically, you know, the idea that a pastor will say, please pay a homegoing visit to the family of the bereaved, right? And but the question I have is, you know, Homesy is very much focused on the idea of bringing transparency to a market that really has been locked up in a monopoly and had monopoly perspective about innovation, especially around residential real estate, for 100 years, right? And so our entire focus is this idea of bringing transparency and legibility to a market that really hasn't had that, by putting data basically in hands of civilians. Through that, though, you know, one of the things that's really important as an investment theme for us in terms of our operations is understanding how to be an ally to the very people who have been disadvantaged by real estate, right? And I wanted to ask you about that very thing, which is not how does it parlay into your investment decisions, because I think it's a moral and emotional connection, right? but rather when you look at startups and you are advising them on like how to actually turn something that's very important, not to be blackwashing, not to be BIPOC washing, but rather to be, or greenwashing if you're in the sustainability space, but how to bring that notion of impact and social responsibility to a project and make it known without it being the focal point, right?
Sure.
How do you make that allyship clear to people? I mean, I have Asian women on my team, 2 women, you know, but 2 old Jewish guys like me.
Yeah.
Also.
Yeah, I mean, you know, to be honest, it's not easy. It's not easy. And in the African American community also, there's much lower uptake on tech. You know, younger African Americans now are quite tech savvy, but many of them are not buying apartments yet or not even renting them themselves. And I've even run into a problem. So with my member LP group, so I live up here in Harlem. Probably 70% of my friends up here are Black. We hang out all the time. I've had no problem getting member LPs on board who are white, Latino, Asian, Indian. But when it comes to the African American community, you're dealing with people who are still, you know, even though it's not sort of evident to all of them, you know, there's a lot of trauma in that community. There's a lot of distrust. You know, the people are going to try and take advantage of them, and it's very difficult to overcome that. And I think one way you can do it is having a member of your founding team or very senior executive who, you know, you trust, who comes from that community, because they can give you insights you're never going to get as somebody like you or me. I mean, look, I'm a middle-aged white Jewish guy, but I grew up here. I live in Harlem. So
Me
I
too.
understand that my father was a jazz and soul record producer in the 60s, right? So I grew up around that. So I've imbued it to an extent, but I'm still a middle-aged white Jewish guy.
Right.
From the U.S. So as a white guy, I probably understand it better than most white people, but I'm still not there, and it's still not a fully lived experience.
And listen, to be real, that allyship has the same issue in politics as it does in Startupville, right? I mean, so it's, you know, it's a social issue, not a business issue.
Absolutely, and I think a lot of it is that. I mean, in my case, you know, I have on the investment side, I have a commitment because, you know, you've got lots of funds that have sprung up who, you know, are just investing in women or just investing in specific minorities. And I think that there's a place for that, but I think over the long term, it doesn't improve the environment for women and underserved minorities. I think far more important that we have existing funds and new funds that are springing up that have a commitment to bringing people together with that. And so I have a commitment that at least 30% of the companies I invest in have at least one underserved minority or woman founder or co-founder. And people say, oh, well, that's low. But it's turning out that most of the companies that I'm looking seriously at have it anyway. So, you know, it's just sort of, I guess, what I'm drawn to.
So hiring targets is certainly one.
I think hiring targets, making sure though that when you're hiring, you're not just hiring because they're African American.
Of course.
Women.
Right.
You know, you want people who are going to come in and really contribute in a meaningful manner because that's the way that they're going to enable you to actually have an impact out of the world. And there's a lot of companies out there and a lot of venture funds that are just hiring so that they can say, oh, look, we have these people on our, you know, in our employee group. But, you know, like you said, it's, you know, it's blackwashing, whitewashing, whatever it may be with that. And, you know, we got to get past that to recognizing that we need people from all sorts of different backgrounds and cultures around us to make the biggest impact and, frankly, to have the greatest success. And by the way, I'm not one who buys into, you know, all of the data that has sort of been coming out to push this. I think a lot of it is BS, but I also know what I see in the real world and I know what I see on the ground. And so that's what drives me to it.
Thanks. It's a complicated thing.
Yeah, I wish I had the answer.
Well, if anybody does, you would. So thank you.
You know, I also wanted to add that even though venture investing is way up, the percentage going to women founders has been dropping. It has dropped the last 2 years, and to Black women founders even more. even
I'm
though it is.
curious in that, in terms of seeing the numbers though, where the percentage, because we tend to get stuck on percentages.
Yeah, it's
But one of
percentage.
the things I don't see is the amounts, right? So, so do you know, Bonnie, whether the amounts have increased though that are going to women and African American founders?
The amounts have increased to women founders and to Black American male founders, but not Black American. Yes.
Yeah. Yeah. One of the other things though that's also happened is, I mean, we tend to lump venture together. We tend to lump venture together, and really venture is essentially three different things. It's early stage, it's growth stage, and it's late stage, you know, pre-IPO stage. And pre-IPO stage especially is really like banking. I mean, to the greatest extent, your risks are really minimized. You've got a ton of data, and it's just a question of when you're going to pull the plug on the exit at that point, whether it be an IPO or sale or whatever it may be. And frankly, those are where the biggest numbers come, and they represent like 70% of all venture investment. Growth stage investing, I think, represents like 22%, and the early stage is only 8%, right? So it's still a lot of money that's going out there, but it's difficult. Another thing that I've noticed, and this is beginning to change, especially with women founders, is there is a lot less money that flows to B2C projects than B2B projects. Because while B2B projects don't necessarily tend to have the highest upside, they tend to be a little bit less risky, right? And you can see, okay, if early on you got some traction with some good clients and they really like what you're doing, you can build on that. It really then becomes just a business development issue and a sales issue. Whereas with B2C, there's so many other elements, you know, building your brand, doing the marketing correctly, being in the right places, you know, not having 12 other companies that are competing for the same eyeballs doing that. And I found traditionally, and it's changing somewhat now, that women founders tend to do much more B2C stuff and a lot more e-commerce. And those are much more difficult to get funded. So while I do think that there is a little bit of misogyny out there, especially among old school VCs, I think the vast majority of VCs, especially, you know, the smaller, more scrappy VCs, couldn't care less whether you're a man or a woman. What they're really looking at is, can you make money for me and my investors? And, you know, so I think the more women get into the B2B space, I think the more we would see those percentages go up going forward. Next question.
Yeah, I'm happy to go with another one.
Oh, sure. Go ahead, Adrian.
Yeah, my question pertains specifically to one of your investment criteria, which, if I understood well, was like some proof of revenue. Could you speak a bit more about that? And
Sure,
like are LOIs good or?
Yeah, LOIs in and of themselves, because they often don't end up coming to fruition. You know, they're fine as long as you actually have on top of some customers who are, you know, paying you something, because you don't have a business unless people want to pay you for what you got, however that revenue is going to be. But more importantly for me, you know, there are lots of people who are out there who are willing to write, you know, these micro funds. They'll write $25,000 or $50,000 checks into a lot of different companies. They basically take the spray and pray route. I can't do that because that goes completely counter to my philosophy. I think it leads to sort of average returns, which is fine for most people, but it doesn't lead to higher returns or greater success for the portfolio companies. So I get very, very actively involved in every company that I work with, and I get involved even before I make a final investment decision, right? Because I want to be able to be helpful and prove that I can be helpful to the companies. Because unlike most VC investors, 80% of what I do is not the check, right? The check is just my expression of belief in the company. And so I will give the companies that I work with an hour or two a week in whatever area that they need help. And I believe that that really benefits the companies. And it also makes it much more likely that we're going to get consistent and higher returns than the typical VC fund. right? So so the revenue is important, doesn't have to be a ton. If you are sort of pre-launch and doing those paid pilots, I do want to see that the companies you're working with are paying you something and that they feel really good about how the pilots are going. They're likely to turn into long-term paying customers. If you have launched, unlike the typical seed fund these days, which, like I said earlier, is looking, they've dropped it a little bit because there's so much competition, but at least 50 to 60,000 in MRR, I would say at this point. If you've managed over the first, say, 4 to 6 months of launching to get yourself up to 15 to 20, and it looks like with my involvement and the involvement of the other investors who are coming in, and I do like to see other investors who can contribute more than a check, at least a few of them in any deal. With that, if it looks like with the money that we're bringing in and the assistance we can give you can get you past having to do that later seed round directly to a Series A, that's where I want to be. That's what I want to be able to help you accomplish, because I want to get you to growth as quickly as possible. I want you to go from being a startup to a real business. And by the way, I don't look for unicorns. I don't believe outside of the Bay Area where it's so incestuous and they all drive each other's valuations up. I think there's a lot of actual collusion out there, which doesn't really get talked about with it. That's not what I'm looking for. You don't have to have the potential to be a $1 billion company. What I'm looking for is companies that can grow to like 30 to 50 million in revenue in 3 to 5 years, have a potential exit valuation of a couple of $100 million or up, but can build real businesses that are going to make a big difference in people's lives. And one part of my philosophy is I only invest in companies, whatever area it's in, that bring joy to their end users, right? So I want to see that. I want to be lit up by what you're doing and whatever it is. So I launched Papa Bear at the end of August, following what I was doing, that process. We made our first investment in October, which is unheard of generally for a venture fund, right? It usually takes a lot longer than that to do it. We're going to be making 2 more over the next month. And I expect we'll probably make 8 or 9 in the first year and then grow to 12 to 14 by the second year. But the first company that we invested in is a company called Otis AI. And it was actually run by a young man who was my mentee during the NYU 300K challenge about 4 years ago. And he had this payments company that he was doing that was going to be for, it was automated payments. When you walked into a bar or restaurant, it would automatically recognize you. You could order right through the app there. You didn't have to wait online for the bar. And I know the restaurant industry quite well. I told him at the time I thought it was going to be a heavy lift because they tend to be Luddites. They're not quick to adapt, to adopt new technologies. And, they managed to get it off the ground, but as I expected, they couldn't really push it forward. And through this process, he became friendly with the CEO of Fiserv, who then introduced him to another guy who had sold his very unique payments processing company to Fiserv. For those of you who don't know Fiserv, they bought First Data. They're now the biggest data company in the world, and they're the biggest payment processing company. And they're actually quite well respected, unlike most payment processing companies. But anyway, so Miguel, who I had been my mentee, he's Filipino American, and Clarence, who he ended up co-founding their new company with, is African American. And they had founded a company. I ran into them at an Upstream Live event. They had founded a company in the ad and MarTech space. And I was not going to invest in advertising or MarTech because I found almost everything I've ever seen has been underwhelming and all competing for the same dollars and not really bringing that joy and making a difference for the end users in any way but a very narrow manner. But Miguel, I liked him. I hadn't seen him in a couple of years. He said, look, I think you'll find this really interesting. So I told him to send me the deck and the demo. And I got it. I took a look at it and I went, oh my God, this is what I've been looking for in this space for years. What they had created, and this is something that actually may be interesting to those of you who are doing a lot of B2C stuff, but it does work for B2B as well, is a digital advertising and media buying company in a box for SMBs. Right? So their whole goal was to create something that was going to reverse the negative impact of what had happened a couple of years ago with Google, Facebook, and Instagram changing their algorithms and driving the costs of buying digital advertising through the roof, making it very difficult for SMBs to compete, and basically meaning that enterprises were buying 80 to 90% of the inventory out there. So they wanted to figure this out. They wanted to figure out a way that they could help SMBs with this. And so they leveraged all this really unique data that they could get, showing what works in the online advertising and marketing space, whether it be social media or on Google. And they created this whole system where you can actually take the data that you have from your prior campaigns that you've run, if you have any, you don't have to have any. Then you put it into their system. You create a new campaign using your creative and their creative. You have access to it as well, right within their system. You test your copy, your images, and your video within their system against all this data that they have to maximize your score, both individually and against each other, right? So that you can maximize the impact of what that campaign is going to do, and launch it across all three of those platforms in 1 hour, right? And since they launched in April of last year, they have about 400. They have about 400 clients at this point. About 375 of them are direct clients, anyone from restaurants to mid-sized manufacturing companies that are selling direct to consumers or even B2B. And then they also have about 25 small to mid-sized digital agencies that are using their platform now because it saves them so much time. They've enabled their clients to 10x their ROI on what they were doing before. So what does that mean? It means that the clients can leverage whatever limited resources they have to generate a lot more sales at this point, and they can take some of those resources and put it into other areas. That's really powerful. So in that sense, they're actually bringing joy to those clients who are using it. And it's easy as can be. Once you get onboarded, like I said, you do all this in 1 hour. It's quick. It's quick. So, those are the kind of companies that I'm looking at. And then the other thing that I was going to say, extremely important to me in terms of the traits that the founders have that I invest in. One is, the number one is they have to be highly coachable, right? That doesn't mean that they have to take everybody's advice, but it has to mean that they're open to listening and absorbing it and making, good decisions over time, over the input they get, from people who know what they're talking about. And in my experience, so like I said, I've mentored and advised over 200 founders at this point over the last 11 years. And I was the principal mentor for one of the Techstars programs here in New York, on the board of EFN in the Bay Area as well, which works with many of the top university innovation programs all around the country. And in my experience, maybe 25% to 1/3 of founders are truly coachable. And this is especially the case when you're dealing with younger founders, first and second time founders who are in their 20s to their early 30s, often let their egos get in the way of their success. And in the end, when you're founding a company, you want to believe in what you're doing, you want to believe in your mission, but it's not about serving you, it's about serving whoever your users are going to be in the end. And, it's about being of service to them with what you're developing. And if, you're stuck on this is the way things have got to be done and this is the way it is, you are almost invariably going to fail. Are there a few people out there who've gone on to be tremendously successful by being that way? Yeah. But the vast majority of them, I'd say at least 95%, are not. And one of the reasons that you don't hear about that so often is they're also people who tend to keep their heads down and really just focus on what they're doing. So,
I just wanted to mention that I'm working on an article, and, there's all these lists of, why companies fail, and it's like team or, product market fit. I think one of the top reasons, which is never on any of these lists, is that founders don't listen to their advisors and mentors. And it's not on any single list, but I would say it's one of the top 5 reasons.
Yeah. Yeah. And by the way, but it is incumbent on a founder to, pick and choose their advisors and mentors.
Yes.
Right. So it's not just about everybody. And this is one of the problems that I have with, so many accelerators, and even some of the top ones, is there is a tendency in these accelerators to get a lot of mentors who have a tremendous amount of big business experience in a variety of areas and their niche, but they're used to working with lots of resources. And so they want to come in and they want to give a lot of advice. And frankly, a lot of that advice isn't very valuable in the early stages. Once you get to, growth or close to growth stage, yeah, but that's not where most people are doing accelerators. And I'd love to see in that world a lot more people who have experience founding multiple companies and dealing with all of the variety of issues, getting involved and serving as mentors, because I think it's a lot more effective. And the other thing as a mentor, though, of course, and some of you may do it already, I would assume at least a few of you are multi-time founders, is, like I said, it's not about them taking your advice. It's just about them being open to hearing it. And don't let your ego get in the way of being a good mentor. So. All right, who's next? Hélène.
Yes, hi, I had a question. So I had a question regarding, what are your views on solo founders versus co-founders? Like, do you have any, things that you're looking at?
I'm a bit hypocritical. I'll be honest. I'm a bit hypocritical about this because I've essentially been a solo founder my entire career. But I did have partners early on, and I just found that generally it didn't work for me. It just, I like to, in the end, be the final decision maker. But I would say in most cases, most people don't have the capability to be really strong solo founders. I mean, I was the kind of person, I'm knowledgeable in many areas and a master of only a few, and that's how I've been since I was a kid. And so like I idolized Leonardo da Vinci when I was young, and I wanted to be a Renaissance man. So I read extremely widely. I've had like 5 careers. So when I meet somebody like that who's done a tremendous amount of things, especially if they have good business chops and they have some understanding of how to work with tech people, I'm okay with that. But if you don't have that experience, especially as a first or second time founder, I always would much prefer to see a good team. Now, there are a lot of VCs who say, well, the primary founder should be a technical person. I disagree with that. I think the primary founder should be somebody who has a little bit of knowledge of tech, but has really good business skills and the ability to honestly assess whether their ideas are going to work. And the willingness to put in the time necessary to do that. And by the way, just sort of touching on that, one of the most important things that you can do before even beginning development is a tremendous amount of customer discovery. So if you got an idea, once you've done your internet research and you've done some of your close-in research, talking to people that you know who may know about that world, especially if you don't come from it, then, getting on and doing structured interviews with 50 to 100 potential clients, that's the absolute key to giving yourself the best chance of really getting off the ground in a meaningful manner. So, I always recommend that. Takes a little time, but it speeds up the process afterwards and ensures that you are less likely to create something that people don't want. Right? So very important. Now, just getting back to your question. So what I like to see generally is I like to see a team that has, a business lead and a technical lead. I prefer to see that they knew each other before, or that if they didn't know and got along well, or if they didn't know each other before, have actually spent like a year working together or 9 months or whatever. And that's going pretty well. And I will get you in a room and I will, if I'm interested in what you're doing, I will jab to see how those founders interrelate with each other, because it's extremely important. I just had a situation. So my second investment was going to be, I won't name the company, but it was going to be a company run by a group of young guys up in Boston. And they had already launched and were, gotten off the ground very nicely. They pivoted a couple of times to get to this final launch. And we're going to literally transform what I felt they were going to transform the real estate rental agency business for the betterment of everybody except for the traditional agencies. And I think they had the chance to capture probably 80% of the rental market in the biggest cities of the country, and overseas as well. But as I got to know them, over a period of months, I started to see lots of problems in the way that they were functioning and operating and in the decision-making process. And this is often the case when you're dealing with really young founders. It's why I tend to like more people. I like a founding team that has different ages in it, which you don't see all the time, because people of the same, similar age tend to like to work with each other. So, for example, Otis, Miguel, the founder, is like 24. Clarence, his co-founder, is in his mid-30s. And then the COO of the company was one of the early investors who put a couple of $100,000 in for the first round. He was the former head of data innovation for Verizon. After he invested, like 5 minutes later, he said, "Hey, this is great what's going on. I love it. Let me come on as COO." So I love when you see that kind of cross-generational founding team or early team. I think is fantastic, right? Because everybody brings different perspectives. The older folks can mentor the younger folks bring energy, those kind of things. But you don't see that often. So this company up in Boston, all these young guys, like 22, 23 years old, they're having this beginning of great success. And I saw the vision really for what this could be. And they saw it to an extent, but they were swinging. But there was one member of the founding team I had a tremendous amount of concern about. I didn't feel that he was honest. I felt he was a hustler. And he said some things in front of me that were not appropriate, and I didn't feel he was doing it. So I told the CEO this, and I ended up pulling out of the deal, really at least 50% because of that. When I initially told the CEO that I was going to pull out, him being young and not super mature yet, blew a gasket and started yelling at me, that kind of thing. And I got off the phone, and then we spoke a few days later, like 3, 4, or maybe 5 days later, and just sort of calmed down. And I said, "Look, you know what? I still like what you're doing. I still think you have a chance of success. I just can't justify making the investment at this time to my investors." I said, and he said, "I get it, and looks like we have the money from other places." Long story short, he texted me 2 days ago. "Something that you told me was likely to happen happened. Do you have some time over the next couple of days to give me advice on this?" So I said, "Well, I'm free on Friday. I could do it." He said, "Well, anyway, you could do it earlier." So I got on the phone with him 10 a.m. yesterday. And the guy that I had a lot of concerns with, he proceeds to tell me, went behind his back to all of the employees and all of the investors and told all these lies about him to try and undermine him in the company and get him out. And he said, I want to tell you, Josh," he said, "you told me and I didn't listen, and I'm so glad that you didn't make the investment. And now can you give me some advice on how to deal with it?" And so,
Wow.
That happens. And this is somebody that I pulled out of the deal on, who still wanted to come back to me and get my own. Because, I've been through this so many times, and I know it, and I can see it from a business and a legal and a personal standpoint, unlike most VCs. So I find that I'm pretty prescient with this kind of stuff. And I'm a no bullshit native Manhattanite too. So, I try not to destroy people's dreams, but I also feel it's very important for me to be as honest and direct as possible, because anybody that I feel strongly enough, either personally or what they're doing business-wise, that I have a conversation with, I want to make sure that when I have that conversation with them, they walk away feeling like they got something of value out of that conversation, no matter what. Doesn't matter whether I'm investing, whether I believe in your project or not. I want you to walk away, with a lot of really good things to think about that can help you, whether it's helping you move forward or helping you go another direction.
Great, sounds good. Thank you so much, Josh.
Ben.
Hi. I've been thinking about 2 questions, actually. They're both, I could cheat and try and frame them as one, but they're really two. But they're both kind of about, I guess, MAP, where I find it difficult to place us on the kind of classic fundraising named journey. We've been at it for a few years and we've bootstrapped revenues around $1 million. It's not recurring, and a lot of that revenue has been defense type customers who are paying for development to be completed, essentially.
So it's more of like more of a consulting model at this point.
Yeah, we are using project-based funding to develop the defensible tech stack. We're starting to activate channel to then very efficiently scale revenues from that tech stack that we've been developing. So we haven't raised money, we have revenues. It's very clear to us, you know, that the pathway is very well lit, what the growth looks like and exactly which channels we activate and all of the large companies that we have LOIs signed with. Well, not LOIs, rather statements of various types of support or MOUs. I can't really tell if we're a seed company or it's just I just sort of say seed by default because we haven't raised.
Yeah, I mean,
it's,
it really, look, you haven't raised yet, but you got to $1 million MRR. It's really, you know, all of these things are so fluffy when you're talking about the early stages now. You know, like I said, what I'm doing, which I call late pre-seed, early seed, used to be called seed. You're doing $1 million in AUM, but that's, you know, like you said, that's you know, non-recurring.
Yeah,
so
I should say,
yeah,
we've got well, there's like about 6 million worth of proposals currently in flight, for example, to really add an inflection point. Things are about to.
But you're probably still driven until you really get that platform completed, right? And you can automate a lot of the stuff and enable your clients to do it. You're still reliant on bodies, right, to get stuff done, I would say, to a great extent. And so as long as you're reliant on bodies in the space that you're in to get things done, it's difficult to pitch you as a true tech company. What I think you've got to do is split that off and say, this is how we've been funding it. This is what we've developed thus far. This is what we need to get it to the point where that platform is going to be, you know, the high value generator of revenue.
Yeah, and that's pretty much how we frame it. It's I guess in terms of the funding journey.
Yeah, until you've got a completed product, you really are pre-seed. You really are pre-seed. Like you need a completed product to really call yourself at that point. That's how I feel.
Useful. I think what really matters for us on that funding journey is, yeah, if we're only raising a small amount of money because of definitions on that journey,
how much do you need to raise at the moment?
We'd be looking for a 2 million round because
you're looking for you're looking for a 2 million round, but they're going to have a piece of the whole company, right? So the revenues that are coming in, or
correct.
Okay.
Yeah,
so
and the real
revenues. I'll tell you what I would do if I was you. I would consider looking at debt finance for at least a piece of that, right? Maybe half of it. Yep. Because you have this recurring revenue that's growing. Or not recurring, but you have this revenue that you pick up every year. It sounds like you're becoming recognized by these various customers, including the defense industry, as people who can really deliver for them the things that they need. So, you know, essentially you're leveraging that revenue. So you could raise $1 million in equity, at a lower valuation to enable you to get it done really quickly, and $1 million in some form of debt finance. And that for you is, I think, probably would be the best way to go.
The strategy at the moment is to raise as a series of convertible notes, and we'll just drift the cap up basically. So earliest money.
Do you know about venture debt?
Yeah.
You do, okay. Is there a reason? Because is there a reason that you're not considering it at the moment?
Purely because it's sort of secondary to having the equity investment that it sits alongside in my head. I could be wrong about that though.
No, not necessarily. There's a lot of people that are just raising venture debt. I mean, Bonnie, you might be able to speak to this a little bit. Oh, you're muted. You're muted.
I see that we're muted. Oh, we should talk all offline, Dan. You have my email, right? We only have a few minutes left, and I don't want to detract from anybody else who might have a question. And I know we have limited time here, so.
But my recommendation definitely would be split it up. You don't need to take, given the revenue that you have coming up, you don't need to take it all in equity. You bootstrap.
Yeah.
You take some equity. I'd say $1 million in equity. You can do it. I don't know what value, what cap were you talking about putting on the convertible?
A stair-step sequence. So the very first checks get very good terms. Ideally, the first money in has essentially doubled its, value by the time we complete a round. So the very first checks should be getting very good.
That can actually be a little funky, especially if you're trying to get some good, some really good VCs in.
But I think
they don't like that. I mean, you can have multiple closes, but using those sweeteners, I don't think is a wise idea.
Interesting.
I don't think it's a wise idea. Yeah, I mean, you want to just commit to closing within a certain period of time. Get it done. Once you have the expressions of interest, then you say, I want to get this done within 90 days. For 120 days, you can do rolling closes with convertible notes, just like you can with a safe. But I don't think there's any need. Just set the valuation across the board at a reasonable amount. And with what you're doing right now, given that you have the safety of the existing revenue streams, which you can build into the deal like that, so they're protected.
Yeah.
I would say for what you're doing, you could probably get a $6 to $8 million valuation easily and get it done quickly at that. If you want to go higher, it will slow it down somewhat, and you'll have to really find the right investors.
I think genuinely what matters most to us is the right people. And it's the people who will help us.
If you only do $1 million in equity, then you can focus on getting the right pre-seed investors on board with this, or $1.2 million, something like that. Maybe a little bit over.
Thank you.
You're welcome. All right. So we have time for, I think, one more question.
One more question. I know, that's why I didn't want to.
Yeah. Anybody else?
Here's your chance, founders. Oh, Carolyn.
Yeah, I have a quick question. I was looking at your website, and thanks for being so direct about what are the things that what you look for. That was, as a founder, that was really great to see and made it really clear, so that you know what you're striving for. I have a question about, you mentioned something about winning competitions as on that list of things that founders should aim for. Can you talk a little bit about why or what you're looking for in that?
There's a few things. It really isn't that some people voted for you. It's more, my feeling is that CEOs of companies should really, if they don't have the natural gift of gab, should really be working on that and really be able to inspire people. Right? It's extremely important if you're going to build a really successful company. And so that to me is evidence, not just that you can inspire investors and people who are knowledgeable, that you can inspire your employees too. Right? So that's what it really comes down to for me with it. And I'm just, there's something else that just sort of popped in and out of my head around that. And it also demonstrates to me that you're taking the time to get your story right, to get your message right. I can't tell you how many presentations I've been given over the years by founders, and I just go, and these are even founders who managed to raise some angel money. I go, terrible, it's not inspiring at all. Maybe you manage to get over on this going forward, but if you're going to really build that company, you're going to raise additional rounds, you're going to do those kind of things. People have to be drawn to you to a great extent. That's why I have a hard time with companies that are, and by the way, this is just my predilection. It's my predilection. It's not necessarily the case for all VCs. But, I have a hard time with companies who have CEOs who founded the company and then foist off all of those kind of presentations to their marketing people, right? Especially when they're key in their core. When I see that, I question things. I want to delve much more deeply into the CEO and how closely those founding team members are involved. And also, you're going to do that, and that founding team member better have been one of the original or very early co-founders, you know, that stepped in, and they better have a decent amount of equity in the company.
Mhm.
I hope
Thank
that
you.
answers your question.
Yeah, no, it did. And it's great actually, because it wasn't what I was expecting. So great. Thank you.
Well, I know we just passed the mark. I don't know if you have time for one more. I don't know if anybody has.
I can do one more question.
Okay.
One more question. Anybody else have a final question? Sam looks like he joined us late, right?
Oh, Sam, did you have a question? Sam usually does have a question. I see he's muted right now, and maybe he's multitasking. We don't know.
Yeah, I have a question.
Sure.
Okay.
Yeah, just a quick one. What are your thoughts on ed tech as a sector?
So my penultimate company, the one that I launched in Singapore, and I was actually one of the few expats to get Singapore government funding as part of the pre-seed round that we did over there. Ed tech is really important, but it's a really difficult space. So I was in higher ed tech. I will never do it again because it's so difficult to get higher education institutions to do anything that doesn't directly lead to new candidates, new matriculants, money for them, even if it's going to improve things on their campus. And yeah, it was very disappointing. So what I had done with this company is we did very sophisticated soft skill and spoken English assessment, one interview-based online, amazing platform for international applicants to U.S. universities as part of the admissions process. So this was for highly selective,
right?
Of course. And we signed up 13 tier 1 universities very quickly in the United States. We did the pilots. They loved it. And then when the political issues around it sort of wound down in the media, the presidents and the provosts, you know, all said, hey, we love what you do. We love these reports we get from you. But we can't afford to limit the number of applicants because it's the only way we have to control our U.S. News and World Report rankings. You know, and everything becomes so money driven with it. And several of the heads of international and admissions directors that we work with actually resigned from the university, and the presidents and provosts, right? So I ran into that. So, you know, from my standpoint, will I look at an ed tech play, especially one where there is some meaningful traction and I see a root growth? Absolutely. And I have some friends who do exclusively ed tech, so they tend to get involved at like Series A and later. Yeah, there's not a tremendous number of highly ed tech focused early stage companies. K through 12 really depends on what you're doing. If you're going to be reliant on local school systems, you better have somebody on your team who has substantial experience selling into those school systems and relationships ahead of time, or it's an extremely long slog and unlikely to get to a point where it really is venture scale. I guess that's the way that I would describe it. So I hope that answers your question.
No, it's very helpful. Thank you.
So Josh, question, did you want to share your contact information? Otherwise,
oh, sure. Yeah, absolutely. So the best way to get in touch with me is right through the website. There's contact us and it comes to me. I look at everything that comes through. And, you know, if it's something that I think there may be some interest, or even if I'm not interested, but I like what you're doing, you know, I'll always get back to you one way or another. But, you know, I often get back to people even who I'm not going to invest in if I have the time to give some input and advice if I think there's some real potential with what's going on. Or personally, if I know, you know, if I've met you and I like you, you know, I'll try and be helpful.
So of course, try to reference the breakfast. That would help, right?
Yeah, absolutely.
Yes,
absolutely. No, that I'll remember. So any of you who wanted to have a conversation with me, you know, right now I have a little bit of time, so I can't give everybody, but you know, because I'm in the throes of recruiting member LPs, which is really going to be core for me to be able to accomplish all the things that I want to do. But if you reach out to me and you think that I can really give you some insights or help, you know, I'll try and fit you in over the next month.
Thank you so much and for your time, and we appreciate all your information and help.
Absolutely. Well, I hope it was valuable, and I enjoyed getting to know all of you and sharing with you.
And don't forget, it's papabear.vc.
Papabear.vc. Yep.
If you're reaching out to the website, very important. And thank you, Kettle Space, as always, for hosting us. And we will be back here actually, the next one will be on a Friday for the first time.
I'm rooting for Kettle OS to take off. You Kettle Space.
And we missed the ribbon.
Yeah, I like Nick and your new.
I'll pass it along.
What is Nick's new co-founder of the OS? What's his name? The
Ryan, that's
Ryan,
CTO.
yes. I like Ryan a lot. I got a chance to talk to him.
So thank you, everybody, and have a wonderful day. And we'll see you in 2 weeks and 1 day.
Thank you. Thank you, Josh.
Thank you so much. Bye-bye.